So some elements of financial modeling, particularly stochastic modeling and data science, don't have a huge amount of overlap. But I want to provide some motivation today for just how we use some of the data science techniques in some of our financial modeling and our risk management. And also just to give an overview of a class of models called economic scenario generators, which might not be well known to many of you. So a slight introduction to that, but again, a huge subject where there's books and numerous papers written on it. So hopefully you'll walk away today with a slight overview of it and how we use it within our clients as well. So to motivate this, every day as individuals, we're exposed to risks and uncertainty. There can be relatively minor ones or maybe major ones: falling down the stairs, using public transport, crossing a road, using a knife to cut up some food preparation. And it's something we may not always give consideration to. Then there are almost a whole nother scale of risk, which not just affects us as individuals, but affects companies and affects the financial institutions, which are the backbone of our economy, like the banks and insurers, for example. So global risks. So many risks not just only affect us as individuals, also affect companies. And one area of that, for example, take some examples. So the war in Ukraine, clearly very problematic for the people in Ukraine, the surrounding region. And as us as individuals, you might see that through higher energy prices in different parts of Europe, or food prices increasing. The increased digitalization of the world, massive benefits to many companies, but it brings about the counterpart to that is the increase in hacking, malware, areas like that. So again, how does that affect us? Probably financially, if we get, and probably a massive problem as well if our things get compromised. Other areas aren't as clear. So take biodiversity loss, not as clear, but still a risk to many things. And all of this is kind of put in the context of just there is uncertainty going forward. So what does this have to do with financial modeling? Well, most of these types of risks companies try and mitigate. So increased risk of cyber threat. Well, you increase your cybersecurity, for example. But a lot of companies will have future cash flows. They'll have liabilities. They'll have massive asset portfolios, which they might be holding for many decades. Many of these also risks will play out over many decades. So how do companies deal with this? And that's one area where we'll want to go on and talk about, is in the use of this modeling. And this is particularly important in financial institutions. So if you take out insurance with a travel company, with a health provider, or even a life insurance provider, if you pay a premium, some money across to a life insurer to insure your life so that some money is paid out upon your death to some group of dependents, that could be 30, 40, 50 years away, or it might never happen. How does a life insurer deal with that? Deal with all that assets they've got, and also ensuring that when the time comes, if they need to pay out the lump sum, whatever it might be, the benefit it might be to the dependents, it has enough money to do so. And this is all in the context of these global risks, the future uncertainty in the economies. And the key theme is that there are many business problems which involve projecting cash flows far into the future, but they're contingent on the future economy, which is very difficult to predict. And there's no one single right answer. So what economic scenario generators do, they try and essentially build a joint distribution of all the different variables which might come into an economy at different times in the future. And then they sample from those using Monte Carlo simulation, which some of you might be familiar with. But the aim is to build up future views of the economy. So essentially lots and lots of different trials of the economy. And in doing so, this can then help people understand how, by applying their cash flows or their future investments into these different scenarios, to see how they might perform and how it might happen. So the slide I'm showing on screen just gives you a very brief overview, a very simplified overview of how these economic scenario generators how they work. So at the very start, we have all this market data, and this is where the big data comes into. There is a massive financial data which has kept academics, people working in industry and elsewhere occupied for most of their lives in just analyzing this and understanding the economics behind it, relationships. So we use some of that within the models. We can't take the whole of it, but we use that in selecting the models and in actually calibrating models, which I'll touch on later. And then we build up a whole economy, essentially building an economy using economic theory, lots of mathematics, and a huge amount of computing power. So these variable assets of interest might be the stock market, the FTSE 100, for example. It might be interest rates. It might be the level of inflation, which we hear about pretty much quite frequently at the moment. It might be the housing market. It might be GDP, the gross domestic produce of a country. And all of these are outputs, essentially in APIs or massive CSVs or whatever format's needed. And they almost produce this big data set, which our consultants or clients can then use in their own tools to help them answer problems of their clients and help solve them. To give you a small example, I thought it might be useful just to show you just an example of an equity output. So what we see here is, so you can imagine this as you start at time zero with 1 unit of currency. And over the next 10 years, using one of our projection models, this is actually one of our actual projections from one of the recent months of how we think things might happen over the next 10 years, for example. And then you get to 10 years and you can see how much money you've got at the end. So 5 might say you start with 1 and you end up with with 5. So you've got 5 times what you get. So if you had $100, you end with $500, for example, in the top chart shown on there. And we do this thousands of times. I won't show all the thousands of ones. And we do it over much bigger time horizons as well. So what you get is not just a single deterministic view of the world. You actually have a whole distribution coming through. And that's quite important. Imagine if you are saving for a house. You're at today's date, and over the next 10 years, you want to save a deposit for your house. Well, you could just borrow your money into the bank account, which is what a lot of people will do. You could use an economic scenario generator and begin to think, well, if I invested some of my money in equities or the stock market, some in interest rate products, some might go into property itself, for example, then what's the best strategy for me to do to make sure I reach my outcome? And the other side to that is thinking about, well, actually, there's a whole other side to this, because what will mortgage rates be like in 10 years' time? What will the housing market be like in 10 years' time? So you can use the economic scenario generator to look at the projections on the other side as well. So this model goes through, just a very brief model. It shows you lots of different and interesting trials, which is quite an important part of it. But you'll see a lot are clustered in the middle. So some clients, some problems will be really interested in almost a summarized view of this. They're interested in what's the average coming through. And so some clients will just want to look at what's the average return and look at that over different time horizons, which is a gray line shown here. Other clients will actually, a lot of people, be concerned about the risk. What happens in those really bad situations? And in those really bad situations, like the 1 in 20, which is shown in blue here, you could lose a lot of money. And that's always a trade-off in a lot of investing, that it's a trade-off between getting good returns and the amount of risk you're prepared to take. So to bring this to life a little bit more, is that how do our actual clients use it? So our own economic scenario generator in-house is called the Economic Scenario Service. And as I said before, we produce a whole lot of data every month, tens of gigabytes, which are then consumed in downstream applications in various modeling teams through our clients and our consumers. And what type of problems are they solving? And they're probably very similar to the ones I just mentioned, but the kind of the background of saving for a house. They're similar to that in some ways, but just on a much bigger scale. So asset liability management. Insurers and pension schemes are our main clients. And you take a very large pension scheme, for example, with billions of pounds or euros or dollars of assets, and they've got a lot of assets there. They're basically the money they've invested in the pension scheme, or the people who put money in as well. How do they invest that? And how do they make sure that they can meet all those pension payments in decades and sometimes 70, 80 years time? And so asset liability modeling can help with that by understanding what might happen in the future economy. Investment strategy, a massive area for our clients and one of the big parts of our business. So there are examples maybe in there is on, say, hedging. So as I was mentioning before, that sometimes investments, you might want to invest in the equity market, in the stock market, but you're a bit concerned about the amount of risk, the chance of you actually losing money. So hedging is a way for people to invest in another asset as well, to maybe get a slightly lower return. So you don't get quite as much money coming back for investment, but you reduce the amount of risk you have in there. So hedging is quite a frequent strategy or use. of investing, of reducing risk within an investment portfolio. And one of the main ones, which is really topical in the financial consulting area and the financial modeling, is on climate. So climate modeling itself within the physical side, actually modeling the climate, is widely known, is a huge academic base, and is really quite important in helping influence political decisions. What is less clear, and there's definitely been work in this area, is how this translates into the future economy and the future financial markets. And at the moment, I still think it's emerging areas, something where there's less clear how it all fits together. But one area we can help with is to present future scenarios. So we could say, actually, clients might be interested in, let's say governments don't do anything and we reach 4 degrees Celsius of post or pre-industrial level increase in temperature by 2100. What does that mean? Well, what are those interesting scenarios we see in the economy? And at the other end, we could say, well, let's say there's a green revolution. What does that mean? And so we can analyze this. Clients have questions, how their portfolios, how their investments, how things might play out. And using the type of models I've been talking about can really help them understand that and manage their risks and make appropriate investment decisions. So I should say, these economic scenario generators are not short-term tools. They're not using for trading or speculating on. They're more for longer-term investment strategies to prevent realistic views of the economy. And in the short time I've got left, I thought I just might mention 3 smaller areas which may be of interest. One is on model calibration. So calibration is picking the parameters in the actual economic scenario generator. So most of them will have thousands of parameters. They're really complex models. And that's even allowing for a balance in not having things too complex, as in having models with 40 or 50 variables, actually just having things which you can observe in the financial markets. And there are different ways to calibrate the models. So we have a huge amount of market data. And there are kind of 2 types of uses of them, or maybe 3, or maybe it's more than that. Yeah, maybe there's a few different types of uses of market data. One, it goes into the initial research of the type of models we might use, and that's guided people in economists, financial economists, in building their actual models, which we then use these stochastic-based models. And I should say there are other approaches to building economic scenario generators. But we such as using economic theories, you have these kind of very bottom-up approaches where you start off modeling almost households and companies and using economic theory. A lot of the ones commercially available use statistical-based models like we do as well. So using historic data, you can actually begin to think about the types of models you have, and then you could use that to get some historic facts, some stylized facts about the different assets you might be looking at or the different economic variables. And then you can translate those into actual parameters in the models themselves. But to get to that, there's lots of data processing, there's lots of data analysis involved as well, which is similar across many other areas of data science. One particular challenge we have is that the historic data is only one element. And as the risks and what we're trying to model in future changes is probably going different to the past, we have this almost unstructured type of data, views from experts, views from central banks, and areas like that, which we need to take account of, which does present some challenges. But overall, it's a kind of an optimization type process to try and fit the distributions or fit the views we've got. So some real challenges and areas for research in the future as well here. So unlike Harry, I didn't give an introduction to myself, but I thought I'd just maybe talk about the team, and I'll maybe bring out some more elements I've done too. But I guess core to the team is maths. We're a team of going to be around about 12 at the moment. And pretty much all of us have got a maths type background. It's there's a lot of mathematics in the modeling and work we do. It's certainly not all of it, but a key foundation, usually like postgraduate and PhD level. One area I've not really touched on, but hopefully you may get a sense for, because of the size of these simulations, there's a lot of software development involved. So we have 2 full-time software developers within the team who manage that really big code base. Even the modelers have got a decent software background in many cases. And then there's more on the actual domain area, the economics of finance banking, and the actuarial side in the pensions and insurance markets, so insurance experience. So a lot of us come in with that, and again, just to try and understand where we're working. Consulting, maybe not one you might necessarily think of, but because of where we sit in the business and us being a consulting business, we do interact a lot with clients in downstream downstream consumers. So we do have a lot of consulting schools, and the ability to research as well. There's a huge amount of academic literature or market literature there which we need to translate. And on top of this, we've also got leadership and project management as well to help progress all the work. One final thing I'll just quickly mention, and that's an enabler. And it's often not one of the things people get excited about in data science or in modeling. And that's governance, and that's a strong governance structure we have, both in the business, it's a business requirement to have good governance, but also in the markets which we work. As you would hope, as I mentioned before about the insurance, if you take out life insurance, you'd expect the payment to be made, even if it's 40 or 50 years' time. So the financial services are really heavily regulated, and as a result, we need to comply with a lot of that. This results in a lot of documentation, all the way through from unit tests and the code base through to the calibration documentation, the types of models we use, and maths behind it, and then all the literature we produce for our users as well. Even though we've got a wide set of skills in the team, we're aware that we don't have everything in there. So we rely on experts through our investment markets, through our investment practice, a business unit who can provide investment views, all the way through to getting views from academics as well. So we do have good, strong governance groups to ensure we have the right people involved. I appreciate that was a very quick tour of a very vast subject, but hopefully there's something in there for everyone.